All right, everybody, let's just take a look at some opportunities that set up really early in the morning. Obviously, there'll be more throughout the day. For example, gold looks like it's setting up. Forget it. So over here, what we have is the ES. I have no idea what's going on here. So I'm not going to be interested in it until it retests 53.7125. If it retests 53.7125, we have a lot of resistance on the left hand side here and here and here. So I'm interested in seeing how it does when it retests 53.71.25 for a short. It seems like it's coming down here near the lows, but this is also an interesting point because of this rally bar. So it might come down here and reverse. I don't know. All I do know is that it's coming down to the overnight lows, and that's also an area where it can react from and perhaps go back up to retest this area of 53.7125. All right, so that's all I got for that. Now let's move over to crude. It's not selling. It went to resistance. It's not selling. So if it's not selling, forget it. Gold, it's at support. 3325.5 was the last level. Now it's at 3317.5, which is below 3325.5. I see a little buying activity. Not enough for me to say that this is a change of behavior. Right there is some buying activity, but not enough move. Although the print is quite high. It's biggest in 18 up waves. That is substantial. So maybe I'm wrong. Maybe I'm wrong and this is a change of behavior. We'll just have to wait and see. It's just that the amount of distance, the wave is not good. It should be a big move, and even the prior wave looks like it's bigger than this wave. All right. Other than that, there is volume coming in. So we just have to wait and see how gold, whatever it does. All right, this was the trade. This is euro. The thing was going down, and it swept to 113.820, and then buying pressure came in. Buying pressure came in, and there's no supply. No supply. So 2.5 times average up volume with only 20% average down volume. You could see big blue and little red. Big blue, little red. A lot of demand, no supply. So when it turned up from here, it was time to get in. All right, so and there was the pop. Now the second thing is the pop is pretty substantial. It's 1.8 times average up volume, has a low volume pullback and makes a higher high. And then after that, pulls back, deep pullback, and that offers a second entry opportunity, which is now running. So this was the trade. It offered two entry points. First entry point was here in this area after this buying activity, and the second one was on this high volume pullback. There is something where for some reason, after change of behavior, many times in many markets you'll see a very heavy selling wave. I don't know why that occurs, but when you see it, you're going to think it's bearish. It's not bearish. That's what I've learned. See, it's all big red and all of that, but when you're coming off of support and buying activity with low volume tests, after that, and this happens typically in the ES a lot, there's heavy selling pressure. And I really don't know how to interpret it other than I already know that this is just a deep drive. And what it does is it actually gives you a pullback entry opportunity. But if you don't know about it, you will see heavy price volume selling and think that this is bearish, but it's not. I don't know what to call this, but It's just like the high volume pullback. That's what it is, high volume pullback. After that, it dries up here. You have 80% and finally only 70% of average down volume, and it reverses. What is this? This is your lack of supply. The other lack of supply was here. You could also consider it your LPS. Now we're taking a look at nat gas. Nat gas, I see the clear bump right here, right, off of the support level. And I was very interested in going long, but, the volume is garbage. 1.1 times average up volume, so I can't, I'm not going to get in if smart money's not getting in. And they're not getting in on only 1.1 times average up volume. Even though it's going up, it's probably because supply dried up. I don't see heavy buying activity at all. Now, this, again, is a high volume pullback, and maybe they bought on the pullback. That is a possibility that, as it's going down, they're buying the pullback, because this pullback has more volume than the rally. This pullback has more volume than the rally. So the only way to interpret this is its effort, meaning because the distance is less and the volume is more, right? It was a hard time going down. Why? Because they're buying the pullback, high volume pullback, also known as effort right here. Right? And now it goes up. Still, for me, it's a no-go. I just don't like the way it looks. And I did not take this. On copper, I don't see anything. I just don't see anything. All right. So what are some of the lessons? Some of the lessons is, first, most important lesson, and I'm going to explain some things right now. So there's a couple of things that must be understood for any trader. And what you'll see a lot of traders do is they look at a chart and look at a 5-minute and start quote unquote reading it. That is wrong. All right, because random on lower time frames you have random orders, and they just, for any reason, it can be whippy. So to handle this situation, we always start with trade location. We always start with trade location. All right. Yes, you may say you can start with trend and then trade location, or you can just start with trade location. But whatever it is, whichever approach you take, you have to have trade location first and foremost before quote unquote reading the market. You read the market at the trade location. You do not just start reading the market all over the place. You read the market at the trade location. The bullishness and the bearishness that you're reading or looking for, or a pattern or whatever it is that you're doing, has to be at a trade location. It cannot just be randomly done on any part of the chart, because there's just too much randomness and manipulation. So this is very, very key. And the most basic type of trade location that's, forever, been around forever, is support and resistance. All right, I'm talking about trade location that this has been around for like 100 years. There are other very, very good areas as well. Some are based on volume, volume profile, right? And this is also excellent, right? Other people will use, there's so much, folks will only get in after it's oversold, or if it's overbought. Some will only get it at, less than 50% pullback, or more than 50% pullback, right? More than 50% pullback, stuff like that. But however you do it, you already know that there's something you look at. And that thing that you look at comes first before reading. So you must have trade location first and foremost. Right? Otherwise, you're going to be spinning your wheels. And one major benefit of trade location, which I like so much, is that you can trade multiple markets. You trade multiple markets. You just look at which one's at your level and then engage. So trade location, the real benefit of it is that it serves as a filter for a lot of randomness and noise. If it's support and resistance, it's based on evidence. What is that evidence? The evidence is that you're looking at a support level where the market already indicated buying activity in the past. So you have a very clear data point. It's not fictitious. You know that the market went up from this point, so I'm going to use that point, right? And then finally, you can trade multiple markets easily. All right. If you use a higher time frame, trade location will allow you to only engage when the price goes to that trade location, and you can trade multiple markets in that way. And I think that's about it. And you can obviously use alerts, because you don't want to be bothered if it's not at the trade location. So trade location first and foremost, and then whatever the rest of your process is, it occurs after prices at that trade location. All right, that's all I got. Take care.